Welcome to the Pro Ticker Deep Dive.
It is really great to be back.
And wow, do we have a show for you today?
Yeah, that's an understatement.
I mean, if you have looked at your portfolio recently, or the news, or just, frankly, the price of gold in the last 48 hours.
And the gold charts.
Right. You know, the start of 2026 has been, well, let's just call it tumultuous.
That is a very polite way of putting it. It has been an absolute roller coaster.
A roller coaster that feels like it's going off the tracks in a few places, to be honest.
Yeah, 100%.
I mean, we were sitting here, it's February 23rd, 2026.
Right.
And the financial landscape looks completely different than it did even just 3 weeks ago.
It really does.
We aren't just talking about numbers flashing red or green on a screen here.
I know, this is much deeper.
We're talking about fundamental tectonic shifts. Shifts in who is running the money, how that money is regulated, and the actual technology that manages it.
It's a total convergence of forces, really.
Exactly.
You have this massive personnel shock at the Federal Reserve.
Yeah.
You have a policy bombshell coming out of the White House regarding credit cards.
Which is huge.
And underneath all of that noise, all those headlines, there is this structural revolution happening with AI and regional banks.
And we are going to unpack all of it for you today.
Every piece of it.
I mean, just look at the volatility. Gold has absolutely crashed.
Just fell off a cliff.
Crypto has taken a massive hit, too.
Yeah, Bitcoin took a beating.
And yet there is this massive rotation happening in the stock market where money is moving from the giants to the little guys.
It's fascinating to watch.
So we have a roadmap for today's deep dive. 3 massive pillars to get through.
Right. Pillar 1 is the personnel shock.
The new Fed chair.
Exactly. President Trump has nominated Kevin Warsh as the next Fed chair to replace Jerome Powell.
And the market reaction was just violent.
Violent is the right word. Gold down 18%, silver down 26%. We really need to explain why that happened.
Then pillar 2 is the policy bombshell.
Your credit card cap.
Right. The president is proposing a 10% cap on credit card interest rates.
Which begs the question, is this an existential threat to banks? Or is it the relief consumers finally need?
We'll dig into that. And then pillar 3 is the structural revolution.
With the tech side.
Right. We're going to talk about why AI is moving from just being chatbots to actual agents.
Agentic AI.
Yeah, and why 2026 might finally be the year of the regional bank.
It is a packed agenda.
It is. So let's just dive right into section 1, the new sheriff at the Fed.
Kevin Warsh.
Right, so President Trump officially nominated Kevin Warsh to replace Jerome Powell.
Because Powell's term ends May 15th, 2026.
Right. This wasn't entirely unexpected. We knew a change was likely coming.
Sure.
But the choice of Warsh that has really set the cat among the pigeons.
It really has. And to understand that violent market reaction,
Yeah.
you have to understand the man himself.
Right. Who is Kevin Warsh?
Well, he is not your typical tweed jacket academic economist.
He doesn't have the dusty chalkboard vibe.
Far from it. He doesn't have a PhD in macroeconomics from MIT like so many of these guys do.
Okay.
He is what's being described as a triple threat elite.
Triple threat. So what are the 3 threats?
Well, he has a deep background on Wall Street.
Okay.
He served in the White House.
Right.
And he has actually served on the Federal Reserve Board before.
Ah, so he knows the building.
Exactly. He speaks the language of the markets, he speaks the language of politics, and he speaks the language of central banking.
Which usually the market likes, right? The market usually loves one of their own.
You would think so.
But looking at the charts, the market seems terrified. Or at least specific parts of the market are terrified. Why is that?
It all comes down to his philosophy. Warsh represents a very significant pivot from the Powell era.
How so?
Well, Powell was very methodical, very data-dependent in a traditional sort of academic sense.
Waiting for the inflation reports before making a move.
Right. But Warsh is coming in with a strategy that analysts are calling tapering plus rate cuts.
Okay, let's unpack that because tapering plus rate cuts sounds like a total contradiction.
It does sound counterintuitive.
Because usually you cut rates to stimulate the economy, right?
Right.
And you buy bonds, which is QE or quantitative easing, to also stimulate the economy.
So exactly. You flood the system with liquidity.
Or, on the flip side, you raise rates and sell bonds QT to slow things down.
To pull money out of the system.
So he wants to do both at the same time. He wants to hit the gas and the brake.
That's the nuance here. It's a very specific needle to thread. Warsh is highly critical of how the Fed has managed its balance sheet over the last few years.
The trillions of dollars in bonds they bought.
Right. Under Powell, we had what we call passive QT.
Passive quantitative tightening.
Yes, which basically just means When a bond the Fed owned matured, they just let it roll off.
They didn't sell it, they just let it expire.
Right. They didn't buy a new one to replace it. It's like letting a lease expire on an apartment.
You just don't renew. Passive, letting nature take its course.
Exactly. Warsh hates that. Yeah, he wants active and prudent QT.
Active meaning
Meaning he advocates for actively selling off the balance sheet.
actually dumping bonds onto the open market.
Yes. He believes the Fed's footprint in the bond market is just way too big and it distorts price signals.
It artificially props things up.
Right. So he wants to aggressively shrink the money supply by selling those assets.
Okay, so that's the tapering or tightening part. That sounds very hawkish.
Very.
That sounds like he wants to tighten financial conditions and pull dollars out, but then there's the rate cuts part.
Right. So he isn't planning unbounded dovish cuts. He's not going to zero.
Okay.
But he does believe the current headline interest rate is too high for the real everyday economy.
For businesses trying to get a loan.
Exactly. So his plan is a front-loaded strategy.
Meaning do it early.
Right. He wants to cut interest rates early and aggressively to help businesses and consumers.
Oh,
And this is the massive. But he wants to combine that with stricter money supply control.
by selling the bonds.
Yes, to prevent inflation from roaring back.
So lower the interest rates to help growth, but have fewer actual dollars floating around in the system to stop inflation.
Precisely. It is a high-wire act.
It really is.
And it's a direct challenge to the traditional idea that you can only push the gas or the brake.
He wants to push the gas on the rates and the brake on the money supply simultaneously.
Exactly.
There is another piece of his philosophy that I find incredibly fascinating. He wants to kill the dot plot.
Oh, yes. This is a huge deal for Fed watchers.
Explain the dot plot for those who might not stare at Fed releases all day.
Right, so the dot plot is a chart the Fed releases every quarter. Every member of the Fed committee puts a literal dot on a graph.
Showing where they think interest rates will be in the future.
Right at the end of the year, next year, and so on.
And it's been the holy grail of forward guidance for years.
Oh, yeah. Markets obsess over those dots.
I mean, you see headlines like, oh, the median dot moved up by 0.25%, sell everything.
It causes massive swings.
And Warsh hates it.
He absolutely hates it. He critiques this intense model dependence.
Model dependence.
Yeah, he believes the economy cannot be reduced to a machine or some theoretical academic model.
It's too complex.
Right. He wants a result-oriented policy.
Meaning based on actual data right now.
Real-time price stability. Not theoretical forecasts from a model that's usually wrong anyway.
He thinks the dot plot creates a false sense of certainty.
Exactly. People treat the dots as a promise when they're just a guess.
So he essentially wants to make the Fed less predictable.
In a sense, yes.
Yeah.
Or rather, less tied to a rigid forecast.
Which gives him flexibility.
Right. He wants the flexibility to react to the world as it actually is, not as a computer model said it would be 6 months ago.
Okay, so let's summarize this guy. We have a new chair who wants to shrink the money supply aggressively.
Yes.
Cut rates aggressively.
Yes.
And stop telling everyone exactly what he's going to do next year.
That's the Warsh playbook.
Wow. How did the market take this?
As I said, the reaction was violent, specifically in assets that rely on a loose money supply.
Like precious metals.
Look at gold. Gold plummeted over $1,000 in 2 days.
$1,000.
Roughly an 18% drop, just wiped out.
And silver.
Even worse, down 26%.
That is a full-blown crash.
It is.
I mean, gold is supposed to be the ultimate safe haven, right? Why does a new Fed chair cause gold to lose a fifth of its value in 48 hours?
Because the market perceives Warsh as intensely hawkish on the money supply. Think about it. Gold loves debasement.
It loves inflation.
Gold loves it when the Fed prints trillions of dollars out of thin air.
Right, because it makes the dollar worth less, so it takes more dollars to buy an ounce of gold.
Exactly. So if Warsh is coming in saying, I'm going to actively sell bonds and shrink the balance sheet.
He is effectively saying he's going to make the dollar scarcer.
Yes.
And if the dollar is scarcer and stronger, you just don't need gold as much as a hedge.
Exactly, which is why we saw a huge short-term rebound in the U.S. dollar index immediately after the announcement.
The dollar spiked.
And it wasn't just gold taking a hit. Bitcoin fell more than 25%.
Dropping below 75,000.
Yeah.
Ouch.
It's the exact same logic. Bitcoin is often viewed by its advocates as a hedge against monetary debasement.
Digital gold.
Right. So if the new Fed chair is this anti-debasement crusader who wants higher real yields.
Real yields meaning the return you get on cash after inflation is factored in.
Exactly. If real yields go up, then non-yielding assets, things that don't pay you a dividend or interest like gold and crypto, they become much less attractive.
So you can just sit in cash and actually make money.
That's the idea.
So the market is essentially pricing in a world where cash is actually king again.
Or at least a world where the dollar has some serious teeth.
That's the initial read anyway.
Right. The market believes Warsh will end the era of easy money regarding the balance sheet, even if he does cut the headline interest rate.
It is a very sophisticated signal the market is sending.
It really is.
It's like the market is saying, we believe he's actually going to do it.
They're pricing it in as reality.
But Warsh isn't the only shock to the system right now.
Far from it.
Because while the Fed is dealing with the supply of money, the White House is taking a sledgehammer to the cost of borrowing it.
Oh, yeah.
Let's move to Section 2, the policy bombshell.
The 10% credit card cap proposal.
This one, I mean, talk about a massive headline grabber.
It's huge.
President Trump has proposed capping all credit card interest rates at 10%.
It is a staggering proposal when you look at the math.
Put it in context for us.
Well, the current industry average for credit card interest rates right now is approximately 21%.
21% average.
Average. Some subprime cards are closer to 30%.
So he wants to cut the revenue potential for issuers in half.
In half, literally overnight.
Just like that, boom.
Yeah.
Now, obviously, this is being framed as a massive populist move.
It is purely populist. The framing from the administration is very specific. It's all about relief for working families.
Right, because Americans are currently drowning in, what, $1.2 trillion of credit card debt?
Exactly, $1.2 trillion. And the narrative they're pushing is that banks are gouging the working class with these usurious rates while pulling in record profits.
And honestly, if you are a voter sitting at home with $10,000 on a Visa card, paying 24% interest.
A 10% cap sounds like an absolute miracle.
It sounds like financial salvation.
It does. But if you are a bank...
It sounds like a total nightmare.
Right. And the pushback from the industry has been immediate and fierce.
I bet.
Banks are balking, to put it mildly. Financial stocks plunged on the news.
Because their profit margins are heavily tied to that spread. But what is the actual argument from the banks? Beyond just, we want to make more money.
Their core argument is about access to credit.
Okay.
This is the classic unintended consequence argument.
How so?
Well, banks argue that interest rates are essentially pricing risk. If you have a low credit score, you mathematically are a higher risk of defaulting on that loan.
You might not pay it back.
Therefore, the bank charges you a higher interest rate to essentially insure themselves against that specific risk.
Okay, so if I'm a risky borrower, I pay 25%. If I'm super safe and always pay on time, maybe I pay 15%.
Exactly. The rate reflects the risk.
Okay.
But if the government steps in and says you cannot charge more than 10% to any one period,
then what?
Then the bank looks at that risky borrower and says, I can't lend to you at 10%. The math doesn't work. I will lose money on average.
So they just don't lend to them at all.
Right. They stop lending to that tier entirely.
Wow. So the very people this policy is designed to help the lower income borrowers who rely on credit to get by.
They might actually get cut off from the banking system completely.
That is a brutal, unintended consequence.
It is the industry's primary warning. They argue this will just force those vulnerable people away from regulated banks and toward payday lenders, pawn shops, or even illegal loan sharks.
Where the effective rates are significantly higher than 21%.
Try 300% in some payday loan scenarios.
It's the classic, be careful what you wish for scenario.
Absolutely.
But let's talk reality here. Let's look at the mechanics. Can he actually do this?
Right.
Does the President of the United States just have a set interest rates button on his desk in the Oval Office?
The short answer is no.
Okay.
Most serious legal analysis suggests he lacks the explicit authority to do this unilaterally via executive order.
He can't just sign a paper and make it law.
Unlikely. It would almost certainly require congressional approval to amend existing banking laws.
And we all know exactly how fast Congress moves on complex financial regulation.
Glacial.
Right.
So because of that many market watchers, for example, the analysts over at CFRA, they view this proposal as more bark than bite.
Bark than bite, meaning it's a negotiating tactic.
Exactly. Maybe he threatens a draconian 10% cap to terrify the banks into voluntarily agreeing to cap it at maybe 15 or 18%.
Compromise.
Or maybe it's just pure political theater.
To show he's fighting for the little guy.
Right, to score populist points while simultaneously appointing a Wall Street veteran like Kevin Warsh to the Fed.
The duality of the administration.
Exactly. Populist on one hand, Wall Street on the other.
But look, even if it is just a threat or theater, it clearly spooked the banks. Their stocks dropped.
Oh, absolutely. They hate the headline risk.
And speaking of the banks, let's actually look under the hood. Let's move to Section 3, the state of banking.
Let's look at the numbers.
Right, we have the Q1 through Q4 2025 data in from the FDIC.
We do.
So despite these scary headlines about caps and new Fed shares, are the banks actually healthy?
If you look purely at the headline numbers, the answer is a resounding yes. They are very profitable.
Okay, give us those headline numbers.
So net income in the first quarter of 2025 was $70.6 billion for the industry.
$70 billion in one quarter.
Yes. And that strong trend held up pretty well through the end of the year. And if you look at ROA, return on assets, which is a really key measure of how efficiently a bank is making money,
Right.
it has been steadily climbing. It went from 1.11% in late 2024 to 1.16% and even higher as we got into early 2025.
So they are definitely making money.
They are making a lot of money. But here is the massive but.
There's always a but.
The credit crack.
The credit crack.
While profits are up right now, so is underlying stress in the system.
Where is the stress?
Non-current rates.
Meaning loans that aren't being paid on time, people are missing payments.
Exactly, 90 days past due or more. Those rates are rising. And they are rising specifically in, you guessed it, credit cards.
Which ties right back to why Trump is proposing the 10% cap in the first place. The consumers are genuinely struggling.
Exactly. There is a real divergence happening in bank portfolios right now.
What kind of divergence?
Well, for the last 2 years, everyone was absolutely terrified about commercial real estate. CRE.
Oh yeah, office buildings were empty, downtowns were ghost towns, values were crashing.
Everyone thought regional banks were going to collapse under the weight of bad office loans.
Right.
But the actual data shows that CRE and office loans are actually showing early signs of stabilization.
Really?
Yes. The bleeding there seems to have stopped or at least slowed significantly.
Okay, so the office buildings aren't taking down the banks, but now the consumer is bleeding.
Exactly. The consumer is showing real cracks. Delinquencies on auto loans and credit cards are ticking up.
Is it a crisis yet?
No, it's not a 2008 level crisis yet.
Mm-hmm.
That's a very clear trend.
Okay.
However, there's a massive tailwind for banks right now that is completely offsetting this consumer risk.
A tailwind.
Yes, the yield curve shift.
Ah, the yield curve. We haven't talked about the 2s and 10s in a while.
Right, because for a long time it was inverted,
Meaning short-term rates were higher than long-term rates.
which is completely unnatural and terrible for banks.
Explain why an inverted curve is so bad for banks, simply for us.
Because the fundamental traditional business model of banking is very simple.
Mm.
You borrow short and you lend long.
Borrow short, meaning they take my deposits, my savings account, and they pay me short-term interest.
Exactly. And lend long means they take your deposit and lend it out to someone else for a 30-year mortgage at a long-term interest rate.
Right.
And their profit is the difference between what they charge for the mortgage and what they pay you for your savings, the spread.
Okay, so when the yield curve is inverted and short-term rates are actually higher than long-term rates?
They have to pay depositors more money than they are making on their long-term loans, which absolutely crushes their profit margin.
It breaks the math of banking.
It does. But now the curve has finally re-steepened.
It's back to normal.
Yes. The 10-year Treasury yield is now significantly higher than the 2-year yield.
Which restores the natural order of the banking universe.
Exactly. It makes the core, boring business of lending money very profitable again after years of pain.
So banks are basically getting a massive pay raise from the bond market, just as consumers are starting to miss their credit card payments.
That is the central tension of 2026 banking right there. It's a race between their profit margin expanding and their loan losses rising.
And whichever force is stronger determines if bank stocks go up or down.
Exactly. And this specific tension leads us directly into one of the biggest investment themes we are seeing right now.
Let's get into it. Section 4, the Great Rotation. Big versus regional banks.
This is a huge shift.
Because for the last year or two, it has absolutely been the too big to fail show.
100%. 2025 was undeniably the year of the big bank.
JP Morgan, Goldman Sachs, Citi.
They dominated. They had returns over 30%.
Wow.
Because during all those mini crises and the CRE fears, they were seen as the ultimate safe havens.
Right. Flight to safety. Put your money with Jamie Dimon.
Exactly. But the pendulum is swinging hard.
Why 2026? Why are you saying this is the year of the regional bank?
A few reasons. First and foremost is just pure valuation.
They're cheap.
They are too cheap to ignore. Regional banks have been totally underloved and underowned by institutional investors for years.
Just left for dead.
Right. They are currently trading at roughly 11 times forward earnings.
11 times. That is low.
Very low, especially when you compare that to the broader S&P 500, which is trading at historically expensive multiples right now.
Everything else is pricey.
So the valuation gap between regional banks and the rest of the market is as wide as we have seen in a decade.
So they are an absolute bargain.
They are.
But, you know, the old saying, usually things are cheap for a reason. What is the actual bull case here beyond just they have a low PE ratio?
It's what analysts are calling the boring bull case.
I love boring. Boring makes money.
Exactly. Smaller regional banks are much simpler businesses than the giants.
Okay.
They generate about 80% of their revenues strictly from spread.
That interest income we just talked about, borrow short, lend long.
Yes.
And since the yield curve is steepening again,
They benefit disproportionately. The big banks rely a lot on fee income, wealth management, trading, investment banking.
complex stuff.
Right. But the regionals mostly just take deposits and lend money. So that normalizing yield curve is a massive injection of pure profit straight to their bottom line.
That makes total sense. What about the fear of regulation, though?
The Basel III endgame.
Right, we heard so much about that over the last year, how these new capital requirements were going to just crush the smaller banks, force them to hold so much cash they couldn't lend.
Well, that regulatory cloud is parting.
It is.
Yes. Recent remarks and analysis out of Washington suggest the final Basel III regulations are looking to be capital neutral,
Capital neutral
meaning they aren't going to force these massive crippling capital increases on the regionals. They are going to be much, much softer than expected.
Oh, wow.
So the overarching fear that regulators were essentially going to legislate regional banks out of existence, that fear is fading rapidly.
And when fear fades and valuations are this low, deal-making starts.
Boom, the M&A wave.
Mergers and acquisitions.
Bank M&A has hit a 7-year high in early 2026
7-year high.
because the regulatory environment is perceived as getting much friendlier, especially with the new administration coming in. Smaller banks are merging rapidly to gain scale.
Because they have to compete with the JP Morgans of the world.
Exactly.
Yeah.
They need bigger balance sheets. So you have cheap stocks, rising profits from the steepening yield curve, and a total green light to merge.
That does sound like a massive recipe for a rally.
It's a classic contrarian play.
Yeah.
Everyone else is chasing these sky-high AI tech stocks, and the smart money is quietly picking up regional banks at 11 times earnings.
Speaking of AI, though, you cannot have a deep dive in 2026 without talking about the technology that is literally eating the world.
It touches everything.
But this isn't just about ChatGPT writing polite emails anymore.
No, we are way past that.
Let's move to Section 5, the AI revolution. From chatbots to agents.
This is the true structural revolution in finance. We are actively moving from generative AI to agentic AI.
Agentic AI. Break that down.
Yeah.
Generative creates text or images, right?
Right, it generates a response.
But agentic means lay.
It means AI that takes action. It executes tasks.
Action is the key word there. What does an AI agent actually do inside a bank?
It completely changes the fundamental economics of how the bank operates.
Okay, how?
We look at a metric called the efficiency ratio,
Efficiency ratio.
which is very simple. It measures how much it costs a bank to generate $1 of revenue.
Okay.
So if you spend 60 cents on staff, software, real estate to make $1, your efficiency ratio is 60%.
Right. And lower is better. You want to spend 30 cents to make $1.
Exactly. So here is the promise of agentic AI. Fully embracing these agents could improve a bank's efficiency ratio by up to 15 percentage points.
15 percentage points. That is a staggering leap in profitability.
It is astronomical. It's not just shaving off a percent here or there by firing a few tellers. It is entirely transformative to the bottom line.
Where is this actually happening, though? Is it just in the branches?
No, the real revolution is what they call melting the middle office.
Melting the middle office. I like that phrase.
Think about all the back office and middle office manual work inside a traditional bank.
Like trade reconciliation.
Right. Compliance checks, anti-money laundering tracking, verifying massive commercial client documents.
All the really unsexy stuff that currently takes thousands of human hours in spreadsheets.
Exactly. One major bank recently cited a 40% cost reduction in verifying their commercial clients.
40% just by using AI.
Just from AI agents.
Yeah.
Because these agents don't just read the PDF document.
What do?
They read it, they verify the data against external databases, they
Right.
cross-check it for compliance, and then they actually approve the next step in the software system.
Without a human ever touching the file.
Exactly. The human only gets flagged if there's an anomaly the AI can't resolve.
That melts the middle office, all right?
It evaporates it.
But that's the back office. What about facing the customer? What about you and me?
This is where it gets really sci-fi.
Hmm.
Think about the concept of the personal CFO.
Personal CFO.
Imagine logging into your banking app. But it doesn't just show your static balance.
Which is all it does now.
Right now, it actively manages your entire financial life.
Give me a real example of what this agent would do for me.
Okay, say you want to buy a house. You tell the app, the AI agent immediately starts budgeting for you. It monitors real-time interest rates.
Okay.
It automatically applies for the optimal loan for you within human-defined guardrails that you set.
Without me filling out 50 pages of forms.
Exactly. Or on a daily basis, it looks at your idle cash and moves your deposits to higher yield accounts automatically overnight just to maximize your interest.
It effectively replaces the need for me to constantly monitor my own money.
Yes, you just set the goals and the agent executes the strategy.
That sounds amazing for the consumer. What about for the bank? How does it help them make money?
For the bank, it completely replaces static marketing. Instead of the bank blasting out the exact same email about a new credit card to 2 million people, hoping 1% click it,
The old way.
the AI agent monitors your transaction history, identifies that you are a high-intent prospect for a specific travel card, and generates a highly personalized dynamic offer for you instantly.
So it replaces traditional search engine optimization and email blasts with agent optimization.
Exactly. It's hyper-targeted execution.
Oh.
This sounds incredibly efficient, but it also raises a massive question about the bank's actual brand.
It really does.
Because if an AI agent on my phone is automatically moving my money around to find the best yield every night, does the bank just become a dumb pipe?
That is the ultimate danger, and we will touch on that deeply in the outro because it's a huge philosophical shift.
Right.
But right now in 2026, the banks that are winning the stock market are the ones aggressively deploying these agents to lower that efficiency ratio.
So the efficiency ratio is no longer just some boring accounting metric.
Not anymore. It is now the primary barometer, the primary indicator of a bank's AI maturity. Wow, so if your bank's efficiency ratio isn't dropping rapidly, investors assume you aren't using AI correctly.
Exactly. You're falling behind the tech curve.
Incredible. Okay, we've covered the new Fed chair, we covered the political bombshells, bank health, and this massive AI tech shift.
We've covered a lot of ground.
Let's zoom out to the macro level to tie it all together. Section 6, Economic Outlook and 2026 Investment Strategy.
Let's look at the big picture.
We are looking at a very specific shape of the economy right now.
The K-shaped polarization.
The K-shape. Explain that for the listeners. One arm goes up, one arm goes down.
Exactly like the letter K. The arm going up right now is business investment.
Driven by what?
AI. AI-driven capital expenditure is just massive.
Oh, right. Companies are spending tens of billions on NVIDIA chips, building data centers, upgrading the energy grid to power those centers.
Right, that corporate spending is driving immense growth at the top end of the economy.
And the arm going down on the K.
The labor market and the low-income consumer.
Right, which we saw in the credit card data earlier.
Exactly.
Yeah.
We are seeing a visibly softer labor market. Now, it's not a total collapse by any means.
But it's cooling off.
It's definitely cooling, and that low-income consumer is feeling incredibly squeezed by the cost of living.
Which brings us to the dreaded I word, inflation. Warsh is terrified of it. Is it coming back?
Well, the consensus from shops like J.P. Morgan and others is that inflation will remain sticky but generally stable,
Sticky meaning?
meaning it's going to hover around 3% in the U.S.
Oh, so it's not going back down to that magical 2% target easily.
Probably not. But the good news is it's not spiking back to 9% either. It's just sticky at 3%.
And what about globally?
Europe is actually expected to be quite a bit lower than the U.S. on the inflation front.
Interesting. Now, a massive part of the global inflation story is always energy. What is happening with the price of oil?
Bearish. Extremely bearish outlook for oil.
Really?
Yes, the outlook is for oil prices to drop to around $58 per barrel in 2026.
$58? That is remarkably low. Why is it crashing?
Supply. Massive, overwhelming supply.
Where is it coming from?
2 places. Lots of new offshore drilling projects coming online globally,
Okay.
and what the industry is now calling global shale.
Global shale. Because it used to just be the U.S. fracking boom, right?
Exactly. For a decade, the U.S. was the shale king. But now other countries have figured the tech out. Places like Argentina are bringing massive shale oil fields online.
So the world is just awash in crude oil.
Completely awash, which is great for consumers, and it acts as a massive anchor keeping global inflation in check.
Okay, so we have sticky inflation at 3% low oil prices and this K-shaped economic growth.
That's the macro environment.
So what does all this mean for our listeners' portfolios? Where are the smart institutional people putting their money in 2026?
Okay, so keeping in mind this is not financial advice.
Of course.
Here's what the top strategists are doing. First, in equities.
Hmm?
The AI supercycle is absolutely not over,
It's still running.
but it is spreading out.
Spreading how?
It's not just about blindly buying NVIDIA anymore. That trade is crowded.
Right.
The money is spreading from pure tech into the utility sector.
Because the utilities have to generate the insane amount of electricity these AI data centers need.
Exactly. It's spreading to logistics companies. And yes, it's spreading to the banks that are successfully deploying AI agents to drop their efficiency ratios.
So it's the AI adjacent trade. Finding the second order winners.
Precisely.
Okay, what's the second big strategy?
Fixed income.
Mm.
Bonds.
Right.
With the Fed signaling rate cuts. Because remember, even if Warsh is hawkish on the money supply, he still wants to cut the headline interest rate.
Right, he's front-loading cuts.
Exactly. As those rates get cut, cash yields are going to fall.
That nice, safe 5% you were getting in your money market fund or high-yield savings account.
That is going away. It's going to drop to 4, then 3.
So what's the play?
Investors need to move out of cash and into bonds right now to lock in these higher yields before they drop any further.
Lock it in while you still can.
Exactly. Extend your duration.
Okay, and the third piece?
Emerging markets.
EM. That's always tricky.
It is a very complex picture right now. Usually high U.S. interest rates really hurt emerging markets because it pulls capital back to America.
Right.
But stable global growth helps them.
So it's a tug of war.
Yes. The key for 2026 is to look for what strategists call transformative elections.
Transformative elections where?
Specifically in Latin America, we are seeing some very big political shifts happening there right now. Pro-business shifts that could really open up those markets to foreign investment.
So don't just put your blinders on and only look at the U.S. There are major structural opportunities abroad if you know exactly what to look for.
Precisely. You have to be selective, but the upside is there.
Man, this has been an absolutely massive deep dive today.
We covered the entire financial plumbing of the world.
Let's try to synthesize all of this for everyone listening.
Sure, I think the synthesis is that we are in a moment of extreme, unprecedented transition.
Right.
We have this new aggressive Fed chair who wants to completely rewrite the rule book on how central banks interact with the open markets.
The active QT versus passive.
Exactly. Then we have this wave of political populism clashing violently with basic banking economics over these proposed interest rate caps.
The 10% credit card war.
Right. And underneath all of that noise, all those political headlines, there's this quiet but massive structural revolution happening.
The AI agents and the regional bank consolidation.
Reshaping the actual plumbing of the financial system.
It really feels like the rules of the game are changing while we are in the middle of playing it.
They absolutely are. And I think that leads us directly to a final provocative thought for the listener to take away.
Let's hear it.
We talked heavily about that AI personal CFO concept earlier.
The agent that manages your money for you.
Right. If AI agents begin making all the actual financial decisions for consumers...
Like automatically switching your credit card balance to get that 10% cap rate?
Exactly. Or automatically moving your savings deposits every single night to whatever regional bank has a slightly higher yield that day.
You're just hunting for fractions of a percent.
If the AI does all that, do banks entirely lose their brand power?
Wow.
Think about it.
Right, because if I literally never log into the Chase or Bank of America app because my AI agent does everything for me in the background.
Do you even care if you bank with Chase?
I don't. I just care what the yield is.
Exactly. In a world dominated by personal CFO AI agents, does the traditional bank just become a dumb pipe for money?
Just a completely commoditized utility, like the water company.
Exactly. And if that happens, the massive profit models we talked about today for these banks, they might look very, very different in 5 years.
The margins would just get crushed. That is a truly fascinating thought to chew on. the complete commoditization of banking brands.
It's coming faster than people think.
Well, on that note, watch the efficiency ratio of your own portfolio, folks.
Yeah.
It clearly matters now more than ever.
It certainly does.
Thank you so much for listening to the Pro Ticker Deep Dive. We will catch you on the next one.
Disclaimer. This content is for informational purposes only and does not constitute financial or investment advice. Always consult with a qualified professional before making any financial decisions.